All right, hey there everyone. This is another video lesson discussing the Greeks, and this lesson will specifically talk about Vega. All right, again, let's just look at the definition here about Vega. It is an estimate, all right? Again, all of these Greeks, I hope you recognize these are all estimates. We're talking about theoreticals. You don't really realize profits or losses until you close a trade. So all of these Greeks, or all of this conversation about the Greeks and what we're looking at, these are all just kind of instrument gauges, if you will, of looking at overall positions or looking at trades. When you're a directional trader, you know what the market is doing. You're picking one direction, up, down, or nothing, right? And there's a whole lot more to trading options, and I think that when you get around the fact that these are estimates, these are theoretical values, there's no hard and fast rule to any of this. It really kind of helps make them a little bit easier to process and understand. So Vega is an estimate of how much, again, the theoretical value of an option changes when volatility changes 1%. All right. So, volatility is just that uncertainty in the market. And you will notice when I say volatility, what's the first thing that comes to your mind? Well, the first thing that comes to my mind is, uncertainty or bigger movements, or, all the things that occur around, say, an earnings event or an earnings announcement, or geopolitical unrest, or a Fed meeting, or any time uncertainty enters the marketplace, volatility is going to change, right? And higher uncertainty means higher volatility. So when you have these higher volatility levels enter the market, well, that is great for traders who sell options, because that means that the prices are higher. All right. It also translates, like it says here, to a greater likelihood for an option to make money. So, that's the definition. Let me show you some examples and we'll put that into play. But like I mentioned in the Theta video, I will have a whole entire folder section of tutorial lessons about volatility, and specifically just talking about Vega. And we are still talking about price, time, volatility. Those are the three components about the Greeks. So when I say volatility, if I just bring up a chart here, let's just look at a simple Russell 2000 chart. Russell 2000, this is a price chart for the prior year. And if we just look at this is from 2014 right here. So you started the year out, you had a few days of sideways, you had a burst up, you had a pretty sharp decline down, then you had a pretty sharp reversal move up, you had some sideways movement, you just had this constant chop around, bounce, bounce, bounce. And what did it end up doing? Here's where it opened the year, right here. Nope, right here, sorry. 1160. Where did it close the year? 81. So 20 points higher than where it started the year. And in the process, in the meantime, there's just all this bouncing around. Well, if you want to look at that on a much clearer visual look, the RVX is an underlying that what that does is that tracks the volatility of the Russell. And you'll notice, let me just bring this over here. So we're looking at the year. We're looking at the year. Every time the market goes down, so this is the Russell, it started dropping right here in the end of January, beginning of February. What did volatility do? It cranked up, all right? You cannot trade the RVX. It's just a price, I don't know, it's not even an equity, it's an index that you monitor this volatility. You cannot trade it, right? So there are no simulated trades on here. Interesting. I stand corrected. Maybe you can. let me get it back to you on that. I know you can trade the VIX, all right? The VIX is the volatility on the SPX, all right? That is fascinating. I wonder, okay, I'll have to get back to you on this. I wonder if that is going to be the next step, if that's coming. Wow, all right. There you go. I just learned something today. But anyway, so you've got the RVX mirrors the Russell, and you will notice that this RVX, when it's down here in the basement, down in the dirt, right? Lower volatility levels mean lower option prices. So at this point down here, it is more optimum to be just buying straight calls or straight puts, because you will benefit from an increase, an explosion in volatility. All right. Conversely, when you get up here and volatility is very high, you know, in relation to, you know, say the prior year, this is 2014, and the highest it got here was 30.05. When volatility is high, you want to be a seller of option prices, option premium. You want to be a net seller of options, because then you benefit when the option prices decline. All right. So what you'll notice, I hope it's easy for you to see that there is a very direct correlation between the market moving down and option volatility moving up. All right. Now that also can come into play. You'll see right here, you don't really have a lot of sharp, harsh surprise move down, but you still have volatility increasing. So, you know, this can come into play with geopolitical events, with, like I said, Fed announcements, maybe earnings seasons. If you looked at Apple, and I think the volatility of Apple is VX-APL, you know, you'll see that the VIX on Apple is kind of, you know, it's all over the place as well. So when you have, you know, I can probably lay earnings announcements and probably tell you exactly where earnings is coming, because you'll see the volatility is building up. Once earnings are released, the news is out, it drops, right? And then it begins the cycle all over again. It builds up. So if that is the premise, and if you understand that concept right there, well, now let's go back and let's look at something like this. All right, maybe we will go back in time. Let's go back in time 10 years. Does that look scary? What about that, right? 2008. All right, so volatility is not to be taken lightly, and I have a whole entire section categorized the silent volatility, the silent killer, because you need to have just as much of a conversation about volatility as you do all the other Greeks and all the other trading elements, because if you don't respect this and you get caught with your pants down and something like this happens, you will have no idea what to do. And you want to talk about margin calling an account, it absolutely can happen just as easily in an options account as it can in any other account. And so you have got to be aware of this risk of volatility. All right, so volatility is high, we want to sell options. Volatility is low, we want to buy options. And what that would look like, just construct a couple of trades. Again, I'm going to divert you back to the boot camp lessons, because you should have been practicing, or you should be in the middle of practicing constructing some of these trades to see how they operate. 30 days to expiration. You know, and let me just make a little side note here. One quick second. Okay, I wanted to go find an image. 30 days is a pretty significant number, and you will notice that a lot of methods and strategies rotate around that. The last video lesson I talked about theta, all right? And what I want you to notice here is from 30 days to 0, you want to notice the shape of this curve, all right? So from 120 days to 90 days, you've got very little, you know, you've got what, a 5% decrease. This slope of this line is very minimal. So from 90 to 60 days, right, it's a little bit greater. From 60 days to 30 days, it's greater. All right, but look at this decline from 30 days to 0 days. Now, a lot of traders believe, myself included, that this is probably one of the most optimum times to enter and possibly even exit trades. I enter some trades at about 60 to 70 days with the intent on being out of them before this sharp deceleration or this sharp decline in option premium. I have other trades where I enter intentionally around this level because I want to take advantage of this sharp decline in this time decay. So 30 days is a pretty significant number, and I just want you to be aware of that because I don't think I've talked about that anywhere yet. So this is something to be aware of. So 30 days, right? If I come in here and I come, let's just go right at the market. We'll just analyze selling that straddle like I did in the last video lesson. Well, now remember our theta was, oh, you know what? I used SPX. Let me just keep consistent here. SPX. If I come in here and if I just sell a straddle right at 2070, I think is where we were at before. Sell a straddle. You know, we have a positive theta. Our delta's pretty flat. Look at this Vega. Hugely negative. Huge, right? Minus 480. What that means is for every 1 point decrease in volatility, you are going to make $480. The reciprocal of that is for every 1 point increase, you will lose $480, right? So when you have a negative Vega number, your opinion and your bias and your standpoint is you want volatility to decline. You want to enter trades in this range when the volatility is on its way down, not down here when it's on its way up, all right? So that's something to be very aware of, and you know, you'll notice that is why I identify these kind of ranges where you'll see, you know, that's a pretty, from 17 to 23 is a pretty noticeable range. You've got a couple little spike outs, but for the vast majority of the time over the last couple years, that is where the RVX has stayed in between. So when it becomes lower than 17, I'm looking to be an option buyer. I want to have Vega positive trades. Not always, but I certainly want to maybe have a few more Vega positive trades than Vega negative trades. And when it bumps up here, well, then I maybe want to be a little bit more Vega negative. And again, that reason is because when the volatility increases, if I have a negative number here, I'm going to lose that amount of money. So the reason that happens, I'm intentionally being redundant here because this is very, very important. When volatility is high, you would like to have a negative Vega number because you will benefit very rapidly when the volatility drops. Okay? So if you can imagine a trade that is constructed when volatility is high, you keep your theta in a very positive range, you keep your delta under control, you can sometimes be in and out of trades in a couple of days and hit 5 or 10 or 20% return on margin all the time. I'm telling you, it is very simple to do once you understand how these operate, okay? So when volatility is low, well, then I don't want this kind of a setup, because if we get that massive explosion up like we have right, say here, we get in a few days we get a very large spike up. Well, that's going to really cause me significant amounts of pain. So then I would maybe want to be long volatility, right? And that tells you, right, look, I have to overcome this theta decay, but for every point I increase in volatility, well, that's what I'm going to make. And you will notice that sometimes that may be as little or as much as from right here, 15.71 to 19.45. So a little over 2 points, or a little over 3 points, 3.5 points, right? So volatility in Vega specifically, the Greek Vega is the indicator gauge for volatility. So just know that right off the bat. I will spend a whole entire lesson about volatility, but you'll notice that right here, it's a estimate. Vega is the estimate of a theoretical value. And so that is important to really wrap your brain around. All right, so hope that helps. The next lesson will be a little bit more, I guess I'll be able to show you, I'm going to step through an option view and show you how to manage a trade specifically with the Greeks, and I'll post up a quick reference card. Okay, so that will be coming up next. Bye-bye.